The Federal Reserve is the institution that controls the cost of money in America. For decades, it has operated on a foundation of extreme stability, using predictable policy moves to keep the global economy from falling into chaos. To maintain that calm, the transition of power at the Fed is usually a quiet 4-year cycle. When a new chair is appointed, the predecessor steps aside to ensure there is only one clear signal coming from the central bank. But that 75-year tradition just broke. Despite the appointment of a new chair, Jerome Powell has announced he isn't leaving his seat on the Federal Reserve Board, citing what he calls unprecedented legal attacks. We haven't seen a dual-chair situation like this since 1948, when President Harry Truman personally asked the sitting chair to stay on. Today, no one asked. The two leaders are simply occupying the same space with two very different visions. This brings us to the new chair, Kevin Warsh. He has spent his recent hearings calling for a complete regime change at the institution, signaling an end to the era of cautious incremental moves. This leadership clash creates a massive problem for the economy. With two opposing philosophies at the top, the rules governing your mortgage, your savings, and your investments are suddenly up for grabs. Warsh's plan is designed as a shock to the system. He's proposing a 4-part reset to dismantle the Fed's traditional playbook almost overnight. First, Warsh wants to shrink the Fed's $6.7 trillion balance sheet, dumping assets to turbocharge the economy. Second, he's killing the dot plot forecasts and cutting meetings, forcing markets to act without a map. Third, he's switching to trimmed averages, filtering out extreme price spikes. Finally, he's challenging the core of the Fed's independence. He argues that autonomy shouldn't be guaranteed. It should be earned by hitting specific economic targets. Warsh claims this regime change is the only way to finally get interest rates lower. By making the Fed's inner workings less transparent, he's turning the world's most important financial institution into an unpredictable black box. There is a vital distinction most people miss. The Federal Reserve only controls short-term borrowing. It does not set the rates for the loans that actually impact your daily life. Those long-term rates, like your 30-year mortgage, are dictated by the bond market. And that market doesn't listen to the Fed. It listens to investor psychology. The bond market's physics are simple. If investors foresee high inflation or uncertainty, they demand higher yields. As the risk scale gets heavier, borrowing costs rise. Now, Warsh's opaque black boxes of risk are forcing panicked investors to drive yields even higher. This is why, despite talk of rate cuts, mortgage rates are hitting 7% again. The bond market looks at the new Fed leadership and prices in total unpredictability. Warsh's strategy relies on the market trusting his new regime change to lower inflation. But by stripping away navigational markers, he inadvertently triggers the exact high-interest environment he was appointed to fix. We are watching a total realignment of the financial rules we've lived by for the last 15 years. The era where debt was cheap and cash was an afterthought is flipping, and the new landscape is rewarding a completely different set of behaviors. The immediate losers in this shift are those carrying variable debt. With the bond market keeping rates high, credit card balances, auto loans, and new mortgages are becoming massive drains on household wealth. On a macro level, the biggest loser is the U.S. government. Higher bond yields mean the interest payments on our $39 trillion national debt are skyrocketing. This creates a loop. Bigger deficits lead to more borrowing, which forces interest rates even higher to attract more investors. But there are also clear winners. For the first time in a generation, savers are being rewarded. High-yield savings accounts and short-term treasuries are offering guaranteed risk-free returns that were unthinkable just a few years ago. Traditional banks are also quietly profiting. They are exploiting the gap between the high interest they charge you for long-term loans and the relatively low interest they pay you for your deposits. The era of Fed handholding is over. Whether this regime change succeeds or not, the message to investors is clear. Stop betting on a return to cheap money. In this new game, the advantage goes to those who stay liquid, avoid debt traps, and don't expect the Fed to bail them out.